Hello and welcome to our August off-market newsletter update. I'm Sam Scharich. In August, we found 104 new off-market sellers. It's the first time we've hit triple digits, which led to 77 calls and meetings in 1 month, 14 new IOIs or LOIs that were submitted, and one feat we accomplished. We had 4 site visits for a single buyer in 1 week. That's a new record as well. We are firing on all cylinders. And if you think about 77 calls and meetings out of 104 introductions made, it's about, I think it's a 74% conversion rate. So not only are we finding leads, we're finding good leads that buyers are pursuing. As for our market update, we're seeing more distress in business sales than we have in the past. Seems like many businesses had a peak here in 2023 or even in 2022, but still high volume of deals getting done. Calder was blessed to hit Inc. 5,000 this year, a testament to the strength in the lower and even sub-lower middle market again. And we're seeing tons of buyers coming from all over the woodworks and bidding on listed deals. Again, important to get some off-market or proprietary in your deal flow Rolodex. I will say I'd love to bring in Patrick Robey, one of our senior deal makers here on the team, expert financial wizard, and just get his thoughts real quick. What is alternative financing? What are some of the pros, maybe some of the cons of pursuing the alternative financing route? So Patrick, if you could just tell us some of the alternative financing options that exist out there.
The alternative financing market has, definitely changed and evolved here over the past, 5-10 years, right? I think back, right, when I was in private equity, 10, 12 years ago, right? Like it was super conventional to just do senior financing with a layer of mezz debt in there. And that was just kind of how you got deals done a lot of times. And, so like I think about it broadly, right? As, you've got senior, banking that can come to the table for an acquisition, mezzanine debt, and then unitranche or alternative financing. And really over the last few years, mezz is still very much available, interest only, usually a 5-year term. It's nice. It's expensive debt, right? 14 to 16%, right? But it's cheap from a cash flow perspective because it's non-amortizing. Mezz is still very much available, right? And helps kind of decrease the equity that somebody needs to bring to the table, since, equity is the most expensive part of the capital stack. But, the unitranche kind of alternative lending space has definitely grown a lot, right? Where, they'll come in, maybe it'll, be 2 or 3 different groups that kind of combine to do a deal, but, they're very creative. They're very flexible, right? In terms of it can be interest only, it can be amortizing, it can be a combination, right? Maybe a portion's amortizing, maybe a portion is interest only. And, that's been a big piece that has grown here over the last few years, whereas senior facilities are just, they've tried to become more flexible, but, ultimately they're super tied to assets, right? And having to lend against that. And, to the degree they can get comfortable with cash flow lending, it's usually not at the same attractiveness, right? From a total lendable amount versus an alternative group. So, but then you've also seen, equity pick up as a piece of the overall capital stack too.
Awesome. No, thank you. And so would you say you've seen an increase in alternative financing today and in recent years?
Oh, yeah, for sure. For sure. I'd say that's definitely become a bigger piece of the market, right? Where I think mezzanine is less often used, and even senior banks, right, are less often used than, or at least not to the degree that I think a lot of alternative financing houses that can, basically do what's been known as unitranche debt. They can come in and basically do the whole deal. That's become, particularly for larger deals, much more attractive and something that's become a lot more in use versus, kind of the conventional senior plus mezz, right?
Absolutely. What would you say are some of the bigger drawbacks or cons of using alternative financing?
It's expensive, right? It's typically going to be more expensive than senior debt, right? Mezz is 16%, give or take, plus they'll have some equity warrants that gets them into about 20% all in. Alternative debt is maybe going to be a little bit cheaper than that, but not that much cheaper. Still, it's going to be certainly a few points higher than senior debt. I'd say that's a big con. And it's also, you've got additional governance and oversight. They're going to be much more, I wouldn't say hands-on, but they're certainly going to be more familiar and require more detail, right, from a financial and governance perspective, and typically will want a board seat and stuff like that. So
absolutely. Patrick, are you using alternative financing in any of the deals you're currently working on? Is there anything you could say to how you're utilizing it?
Yeah, so I mean, like one deal that we're closing right now, which is a great example. It's a low fixed asset company, right? They do about a little over $4 million of EBITDA, and it's a $23 million enterprise deal, but they've only got maybe $1 million of fixed assets, right? So as a senior bank, right, they've got some working capital, right? Maybe $2.5-3 million of working capital, but the asset base really isn't there to support a huge senior bank facility, and so rather than try to get some senior financing plus a huge mezz piece, we went to a conventional mezz group that's coming in and doing the whole deal. And, it's mostly kind of features mezz characteristics, but it's really, they're taking a first lien on all the assets. So that's different. And they're really doing the entire loan. So that's a good example of where alternative financing has worked really well for this particular buyer.
Thank you very much, Patrick.
Yeah, no, absolutely.
And that will do it for this month's update. We look forward to catching you next month.